spent a lot of my youth playing tennis just in these courts right here, and what I loved about the game so much was the strategy involved. And little did I know so many years later that tennis, a lot of the strategies in tennis can be really applicable to investing. There was a book written several years ago by a man named Simon Ramos called Extraordinary Tennis for the Ordinary Player. And essentially what he did was take the concept of tennis, which is basically the same rules that apply for everything, and break it down into two different types of games. One for the professional tennis player, and one for the rest of us, the amateurs.
In the professional game, or game played by highly skilled players, matches are won by making winning shots, in other words service aces or returns for winners, passing shots. The rallies are long and mistakes are kept to a minimum. As a result, you win matches by winning points and not by losing points by making mistakes.
In the amateur game, mistakes are made much more often. So matches and points tend to be won by getting your opponent to make more mistakes rather than you trying to make winning shots. The moral of the lesson here is if you can just get the ball over the net without any regard to skill or speed and hitting the ball 100 miles an hour, chances are you're going to win more points, and your chances are you're going to win more matches than your opponent is. And it's kind of interesting because growing up here watching a lot of people play tennis, I saw so many times where clearly the better skilled tennis player would lose to an inferior player, mostly because that inferior player would just have an incredible ability to just get every ball back over the net and make the other opponent make more mistakes. There are just a lot of similarities between the strategies in tennis and strategies of investing. And even though the concept of investing the rules are the same for everybody, essentially you can break investing down to two similar type of games. One for the professional investor and one for the individual amateur investor. Now, the professional investors, I would classify those as simply those ones working actively in the financial services industry and whose job is essentially to actively manage portfolios, whether it be pension funds or mutual funds. And their goals are try to, essentially trade their way to better returns and try to look for 1% returns on every kind of investment that they make, and over time accumulate a significant amount of returns that'll outperform the market. The amateur investors, which I would classify those that don't work in the financial services industry, have demonstrated we tend to demonstrate a proficiency for earning subpar returns, and a big reason for that is emotions tend to get the best of us while we're making our decisions. Also, as well as we're not obviously actively following the nuances of the market. But a big reason also is that as amateur investors, we kind of are interested in trying to adopt professional strategies. And it's no coincidence that the financial services industry offers so many different kind of actively trading type of products to get us into the mindset of trying to trade like a professional investor, when in fact that's probably the worst thing you could be doing. So the question is, what is an average investor to do? Well, the best way to do it is to simply take this, the tennis analogy, and that's try to essentially play to not lose. And the best way to do that is to adopt the mentality of just staying invested in the market, staying in the game. And the best way an average investor can do that is by taking a passive approach, by buying ETFs, exchange traded funds, or individual stocks and holding them for long periods of time. That's a much more effective way of beating a professional investor who is more interested in churning their portfolios and buying and actively selling and trading.
So in order to defeat and outperform our professional investor counterparts, we need to do a few things. First, we need to invest for the long term and stay invested in the stock market for as long as possible. From a tennis perspective, we just want to keep the rallies going. And at the same time, we just want to make fewer trades to keep our costs down. Next, we need to adopt simplicity and try to avoid doing stupid things like chasing fads or following religiously what the pros and the consensus is doing. In other words, from a tennis perspective, we want to try and avoid doing those fancy trick shots. As investors, we need to be focused on buying high-quality, well-run businesses that are creating tangible wealth, or buying a basket of companies using simple generic ETFs. We also need to make sure that we are not overpaying for these investments or are trying to average those costs down over a long period of time. Finally, as investors, we need to realize that we will make bad investment decisions, so we need to be able to manage and control our losses. Again, from a tennis perspective, we want to avoid trying to make unforced errors like hitting the ball in the net or double faulting our serves or hitting the ball out of bounds.
The longer you can stay invested in the market, the more opportunities you're going to have to outperform the pros, either by the foolish behavior of professional investors or by just simple and organic opportunities that are just going to naturally come up.
In other words, don't try to make those amazing hitting the ball through your leg shots like Roger Federer. We should just focus on getting the ball over the net.
Tennis and investing are two intuitively simple games. Your best bet to be proficient in both of them in the long run is to adopt first principles. Just get the ball over the net, keep the rallies going, and invest for long periods of time. If you do that, you have a greater chance of defeating your professional counterparts.